Well, I think if we go back to prior to the SVB and the banking situation, there was certainly a fear that the central banks were moving very quickly and aggressively, and that was going to severely curtail growth. But as we've seen out of Australia this morning, the comment about the labour markets can be said in the US and here in Europe. The labour market remains pretty tight. We are seeing headline inflation starting to come down, and that's a base effect, as we saw the energy prices last year. But we haven't quite seen that same reduction in food price inflation, and that's certainly a big concern. So I think the balance of the inflationary picture and the growth picture was looking more towards growth than inflation. But then we've had the start of the banking situation, and that the situation with SVB and then Credit Suisse, we'll start to see credit really tightening. So in fact, the credit markets are starting to do the job of central banks by reining in credit. Hence that expectation now coming through that central banks will start to cut rates next year.
When it comes to that tightening we're seeing in credit, which sectors are most vulnerable?
Well, any sector that's levered, so that are reliant on debt, and that probably does take us into that real asset sector, so private equity, real estate. And there's been a lot of conversation about real estate requiring huge amounts of refinancing in the next few years. And interestingly, obviously, you're saying about real estate, the market up this morning. I'm sure that's related to the fact that there was a bid for industrials REIT by Blackstone at some 40% plus premium to the share price close. So whilst the commercial real estate sector is very exposed to debt and higher interest rates, the market is putting a blanket sort of negative view on those stocks, and hence they're undervalued. And then you see situations like Blackstone, who are a huge global real estate specialist, coming in to pick off that value that the market isn't seeing.
How long do investors have to wait if they follow suit and pick up some of these these assets within the commercial real estate sector, which are seeing depressed valuations?
Yeah, I think it's wrong to tar the whole sector with the same brush. If you look at specific stocks, there are certain areas of the market that are still seeing good rental growth. Taking industrial REIT as the example, because it's in the public market, it wasn't that highly levered, maybe like 30%. So, there are opportunities to say which areas of the market will not be quite as impacted. So rental growth being one, strong subsector, so industrial still a strong asset class within real estate, and not extremely highly levered.